Most of you view the world through a windshield that has long been covered in cracks, yet you continue to believe that the road ahead is safe. You wake up, check the figures in a mobile app, and feel a false sense of calm because these numbers seem real to you. This is your first and most fatal hallucination. You confuse price with value and a promise with possession. I arrived at my conclusions not through emotional impulses or speculative gambling. My foundation is the cold study of long-term debt cycles, monetary history, and that unchanging biological program that has governed human behavior for thousands of years. And today, all these indicators are screaming one thing. We are approaching a critical tipping point. Look at your hands. If they are clutching a smartphone or a stack of banknotes, you are holding merely an abstraction whose existence depends on collective faith in a system that has already begun to rot. We live in a period that mirrors the greatest collapses of the past with frightening accuracy. Excessive debt becoming the norm, chronic budget deficits, currency devaluation, and, most importantly, rapidly vanishing trust in the very idea of money. Every empire that has ever dominated this planet has passed through this finale. And at each of these points, tangible stores of value became the only bridge across the abyss for those who wanted to preserve their power and status. Gold is an understandable symbol. Its role in such moments is obvious, but that is precisely where your opportunity lies. Silver remains deeply misunderstood, and this collective delusion is exactly what creates the space for a grandiose redistribution of capital. Silver is money. It has been money for thousands of years, long before central banks and modern currencies based on trust in officials appeared. Its value was recognized by all civilizations for one simple reason. Silver cannot be printed. It cannot be manipulated by a snap of the fingers or created out of thin air. Today, society makes the mistake of viewing it exclusively as an industrial commodity. But this is only half the truth, hiding a deeper monetary essence that is beginning to awaken. Your neurochemistry is tuned to chase short-term dopamine from rising stock markets. But you ignore the cortisol that should be flooding your blood when looking at charts of national debt. When you piece all the elements of the mosaic together, a merciless picture emerges before you. Periods of stability are inevitably replaced by periods of excess, and excesses always, without exception, end in monetary distress. These transitions are never comfortable, but they are strikingly consistent. We are in a phase where governments spend far more than they can afford, and the value of money itself is being called into question. In such moments, capital behaves like a frightened animal. It instinctively runs away from paper promises toward things that have held value for centuries. Silver has always been one of such refugees. In the conditions of any large-scale monetary transition, trust becomes the most expensive currency. People suddenly realize a simple and brutal truth. Money is worth exactly as much as other people are willing to give for it. And when this faith weakens, alternatives instantly gain weight. Historically, silver filled the niche of daily exchange and wealth preservation, not because it was fashionable, but because of its physical properties: scarcity, divisibility, durability, and universal recognition. These characteristics do not disappear just because we live in a digital age. On the contrary, in a world where everything becomes virtual and infinitely copyable, the physical limitation of a resource becomes the highest form of luxury. Currently, the foundation of the global system is stretched to the limit. Debt levels are historically high, and the only solution elites choose time and again is the creation of even more empty money. This approach may delay the catastrophe for a while, but it is incapable of preventing it. Over time, the purchasing power of your currency falls, even if it happens quietly and unnoticeably to the majority. Prices rise, savings melt away, and you are forced to run faster just to stay in place. This is exactly the environment in which silver begins to shine for real. The most important thing here is that silver is not just reacting to fear or speculation right now. It is responding to powerful structural forces that accumulate pressure for decades, only to release it instantly. Monetary transitions are never announced in advance. They unfold slowly and then happen all at once. When trust collapses, a mass flight into trusted assets begins. And silver has always been one of the main destinations. In past cycles, the role of silver as money became obvious precisely when paper claims to wealth ceased to protect purchasing power. During inflations, currency reforms, and debt restructurings, silver retained value not because the government supported it, but because people supported it. Trust shifted from institutions to tangible reality. One who understands this mechanism does not wait for the crowd's approval. Chapter 2. The Silent Executioner of Savings. You believe that safety is the absence of movement, but in the world of finance, immobility is slow and conscious suicide. One of the most destructive forces shaping the future is the relentless and often underestimated erosion of currency value worldwide. This process does not happen overnight. It unfolds gradually. And that is precisely why most people do not notice it until the system suffers irreparable damage. You are used to trusting institutions, but governments rarely admit that currencies are intentionally weakened. Instead, they package their actions in sterile terms: stimulus, support, or stabilization. However, regardless of the language used, the final result remains unchanged. An ever-increasing amount of empty paper chases the same amount of real goods and resources. Throughout history, when governments faced unmanageable debt levels and slowing economic growth, they always chose the path of monetary expansion. Raising taxes too aggressively is fraught with social upheaval, and cutting spending is politically impossible. In this trap, printing money becomes the least painful option in the short term. This creates an illusion of stability that lulls the masses into vigilance. But in the long term, this mechanism works like a silent pump, transferring wealth from those who save to those who are in debt. The purchasing power of your money steadily declines, even if official inflation statistics try to soften this picture. In such an environment, the risk profile of any asset you are used to considering conservative changes fundamentally. Cash, often perceived as a safe haven, becomes a guaranteed loss in real terms. Bonds, once the cornerstone of defensive portfolios, lose their role when interest rates fail to keep up with inflation rates. Even stocks, despite offering some protection, become vulnerable to valuation risks and political interference. As trust in these instruments weakens, investors are forced to seek other ways to preserve their purchasing power. This is exactly where our dialogue returns to silver. Unlike fiat currencies, silver cannot be created by government decree. Its supply is strictly limited by geology, time, and capital. When currencies are diluted, the relative value of finite assets rises naturally. This is not speculation, but a cold mathematical relationship. If the unit of measurement loses value, the things being measured seem more expensive. The uniqueness of the current moment lies in the fact that currency devaluation is happening almost universally and simultaneously. In the past, weakness in one currency meant strength in another, but today, competitive devaluation has become a global strategy. Central banks are trapped in a cycle where any tightening of policy threatens financial instability, while easing threatens uncontrolled inflation. This leaves them extremely narrow room for maneuver and undermines trust in paper money as a whole. Money is, ultimately, a claim on future goods and services. But when there are too many such claims, their reliability disappears. Silver, on the other hand, is not anyone's promise. It is a tangible asset with intrinsic utility and historical recognition that does not depend on faith in state institutions. In periods of accelerating devaluation, people's behavior changes. They move away from holding excess cash and seek assets that cannot be diluted, those that have survived previous monetary collapses. The centuries-old history of silver as a medium of exchange gives it a colossal psychological advantage during such transitions. Even those who have never owned this metal before intuitively understand that it represents something real in a world of abstractions. There is a critical lag between the actions of regulators and the reaction of society. Central banks can expand their balance sheets today, but the consequences are felt only after some time. This delay breeds a dangerous sense of complacency. By the time the loss of purchasing power becomes undeniable, markets correct rapidly. Silver has historically demonstrated a powerful reaction in precisely such moments, not because it changed on its own, but because the perception of reality changed. For silver to show outstanding results, it doesn't need perfection. It only needs the continuation of current trends. The more money is created in the system, the more valuable scarcity becomes. In this sense, silver acts as a mirror reflecting the true cost of the monetary policy you are pursuing. It does not rise in price in absolute terms. It is your money that becomes cheaper. When this realization spreads among the masses, the role of silver shifts from the category of a forgotten metal to the category of necessary protection. Central banks are locked in cages of their own debts, where every movement only tightens the noose around the neck of the fiat system. You make a fundamental mistake when you try to classify reality into convenient but false categories. In your view, silver is either a poor version of gold or a component for electronics production that can be replaced or ignored. This misconception is your cognitive poison. Silver occupies a unique, almost anomalous position in the global system, existing at the intersection of two powerful forces that never meet in any other asset. It is simultaneously a strategic metal and a monetary metal. It possesses a dual identity, which is not a theoretical model, but a hard structural reality, ensuring it exceptional strength in the coming years. On one hand, we have money that has passed through the crucibles of thousands of years of history as a store of value and a medium of exchange. This trust was not imposed by the decrees of officials. It arose naturally because silver cannot be easily devalued. Its scarcity is real, and the supply is limited by nature itself, not by someone's political will. These characteristics form the foundation of honest money, and they matter today, just as they did 500 years ago. Even if the modern financial system tries to convince you otherwise, On the other hand, silver is an indispensable element of modern civilization, without which your high-tech future simply will not arrive. It is one of the most electrically conductive metals on the planet, making it critically important for electronics, renewable energy, electric vehicles, medical technologies, and advanced defense systems. Solar panels absorb silver on a massive scale, and the global energy transition only fuels this hunger. Unlike financial demand, industrial demand does not evaporate during economic turmoil. Often, it only grows as governments invest in infrastructure to stimulate growth. This is where the uniqueness lies. Most monetary metals have no industrial significance, and most industrial commodities are not recognized stores of value. Silver is both. This means it can experience powerful demand pressure from two sides simultaneously. While investors seek protection in it from currency devaluation, industry demands it for its functioning. When these vectors coincide, the impact on price proves crushing. Your neurochemistry responds to scarcity predictably. Cortisol forces you to seek safety when you feel a threat to your status and resources. But you do not see the most important mechanism. Unlike gold, of which almost every gram ever mined by humanity still exists in the form of bars or jewelry, silver is actively consumed. The industrial use of silver in electronics or medicine is, in most cases, irreversible. It is either impossible or too expensive to extract it again. This metal literally burns up in the furnace of technological progress, which systematically reduces available above-ground stocks. Modern financial architects have intentionally pushed silver to the background, labeling it a simple commodity. This manipulation of consciousness causes the masses to underestimate its significance during periods of systemic stress. But when currencies lose their strength and faith in paper assets evaporates, the monetary function of silver inevitably surfaces. It does not need official recognition from states to become money again. It is enough for people to start trusting it when all other alternatives fail. While politicians are focused on maintaining short-term stability, they ignore the arithmetic of real assets. More IOUs are created against a resource that is finite and vitally necessary. This is not a prediction. It is a mathematical fact. When the market finally realizes this imbalance, silver will stop behaving like an ordinary commodity. It will begin to trade like money, and its price will stop reflecting only industrial demand, starting to account for fear, the need for protection, and the preservation of purchasing power. Understanding this dual role allows one to see why silver can remain undervalued for years, and then make a leap with such force that seems impossible to ordinary linear thinking. In a world where financial systems are stretched to the breaking point and technologies are accelerating, this paradox of dual nature becomes an absolute advantage. You are accustomed to a world where any need is satisfied by the push of a button, and any shortage is eliminated by increasing production capacities. Your faith in market elasticity is another layer of mental armor protecting you from realizing the coming chaos. Most people mistakenly believe that if the price of an asset skyrockets, supply will simply adjust, production will grow, and the system will come into equilibrium. This rule works for paper contracts and some renewable goods, but it is absolutely powerless before the physical reality of silver. The supply of this metal is limited by structural factors that are beyond the control of politicians, central banks, or even the most aggressive investors. The main secret the industry prefers not to advertise is that silver, for the most part, is not mined as a standalone metal. The overwhelming majority of global production is a byproduct of mining deposits of copper, lead, zinc, and gold. This creates a fundamental paradox. Silver supply is practically unresponsive to its own price. Even if the cost of an ounce doubles or triples tomorrow morning, mining giants will not be able to instantly increase output volume unless it is justified by the market for those primary metals for which the ore is crushed. Decisions on extraction are dictated by global demand for copper or prices for industrial metals, not by your desire to save your savings through silver. Mining is not pressing the print key on the Federal Reserve's press. It is a heavy, capital-intensive process requiring decades of planning. From the discovery of a new deposit to receiving the first batch of pure metal takes from 10 to 20 years. Every step on this path is mined with environmental regulations, bureaucratic delays in obtaining permits, political risks in unstable regions, and colossal difficulties with financing. As a result, silver supply remains relatively fixed in the short and medium term. You can print trillions of dollars overnight, but you cannot print a single gram of silver and cannot force the earth to yield it faster. The situation becomes critical if one looks at the state of world reserves. Unlike gold, which has been accumulated and carefully stored in vaults for centuries, silver is actively dispersed and consumed. A huge part of the silver mined over the last centuries has been used in industry and medicine, and today it is effectively lost, as its secondary recycling is economically unfeasible. This means that the volume of actually available metal that can enter the market in response to a sharp spike in demand is many times smaller than the layman imagines. In the silver sector, there are no massive warehouse stocks capable of stabilizing the price during a shock. When supplies run out, buyers ranging from tech giants to private investors are forced to enter into direct and fierce competition with each other. This struggle for a physical resource is the true driver of price, not gradual market adjustments at all. The problem is exacerbated by nature itself. The quality of ore is steadily falling. Every year, humanity has to process more and more rock, spend more energy and capital to extract the same ounce of silver. Rising energy costs, a shortage of skilled labor, and geopolitical turbulence only tighten this noose. Mining is not just becoming more expensive, it is becoming physically more difficult. Meanwhile, industrial demand, especially in the high-tech green energy sectors, continues to grow without stopping. Investment interest during a period of monetary stress is superimposed on this industrial foundation, creating a cumulative explosion effect. The silver market is negligibly small compared to giant financial markets, and even a minor redistribution of capital is capable of completely paralyzing the available supply. When investors and industrialists realize the shortage simultaneously, the price mechanism is forced to do the work of rationing a scarce resource. Prices skyrocket not because of someone's speculations, but because it is the only way to balance demand in conditions of rigidly limited supply. While your attention is distracted by the noise of the news, these limitations have been accumulating under the surface for years. The market is not broken. It is simply beginning to react to a reality where a finite and vital resource collides with the endless appetite of the system. One of the most indicative signals in any market is not universal enthusiasm, but complete, icy neglect. Assets that are on everyone's lips and constantly discussed in the media, as a rule, have already fully incorporated all possible expectations into their price. True potential is hidden where most see only dust and irrelevance. Today, silver is in exactly this category of deep oblivion, and its undervaluation is not an annoying accident, but a direct result of decades of distorted incentives and your own short-sighted thinking. For many centuries, a strict mathematical relationship existed between gold and silver, reflecting their relative rarity in the Earth's crust and their joint use as money. Although this ratio fluctuated periodically, extreme deviations from the norm rarely lasted long. Today, this ratio is far beyond historical standards, which directly indicates that silver is valued significantly below the levels at which it has traditionally stood in relation to gold. Such imbalances do not guarantee immediate correction, but they serve as a clear signal of the colossal tension accumulating under the thin skin of the financial system. When you compare silver with modern financial assets, the picture becomes even more surreal. Stock markets have been inflated for decades by artificially lowering interest rates and endless liquidity injections. Prices for paper assets grew exponentially faster than real labor productivity or real incomes of the population. This created a dangerous gap between the virtual valuations of companies and their actual economic output. Silver, in contrast, practically did not participate in this expansion. Its price hopelessly lagged behind, while the cost of living, the total money supply, and levels of financial leverage soared to the skies. Such divergence is historically anomalous, and it is impossible to maintain it indefinitely. If you look at the real purchasing power of this metal, you will see the scale of your loss. In history, there were long periods when a certain amount of silver could purchase significant tangible assets, land, energy, or skilled labor. Today, its real value relative to long-term averages is at a critically low level. Current quotes reflect not market equilibrium, but deep collective pessimism. Psychology here works as a filter, weeding out the weak. The high volatility of silver scares most investors, forcing them to associate this metal with dangerous speculation rather than a safe haven. It is this distorted perception that keeps capital on the sidelines, thereby even more strongly cementing the phase of undervaluation. Ironically, this very volatility is a consequence of the market's narrowness. When the mood finally changes, the small volume of available supply will lead to explosive movement. Institutional giants also contribute to this price distortion. Their huge capitals require assets capable of absorbing billion-dollar injections without sharp spikes, and the silver market is too small for them. As a result, silver is systematically absent from portfolios, despite its obvious protective properties. The official discourse intentionally supports this blindness. Gold is openly discussed as a reserve asset of central banks and a hedge against inflation, while silver is almost never mentioned in the context of state stability. This frame of perception dictates your behavior, forcing you to ignore centuries of history. But history does not dissolve into thin air just because it has become inconvenient for the current agenda. Undervaluation is not corrected gradually. It persists for years until a catalyst appears. A sharp jump in inflation, financial instability, or a sudden loss of trust in paper promises. When this moment arrives, silver does not require new technological breakthroughs to justify its value. It is enough for it to simply appear before the world again in its true quality. The coming revaluation will not seem logical to those accustomed to the comfort of the current system. But for those who understand the mathematics of cycles, it will be the natural finale of a long period of lies. The most dangerous illusion in which you prefer to drown is the belief that this time, everything will be different. You look at your digital interfaces, at the complexity of financial instruments and data transmission speed, believing that technologies have repealed the laws of human nature. This is a fatal mistake. Technologies change, decorations are updated, but biological programs of behavior remain constant for thousands of years. When true uncertainty appears on the horizon, people always strive for safety. And when paper safety evaporates, tangible assets reclaim the throne. Silver has played this role for centuries, and there is not a single piece of evidence that its mission is complete. There is only evidence that this mission has been temporarily forgotten. The greatest threat in any large-scale economic transformation is not price volatility, and not even temporary losses, but a paralyzing sense of complacency. It is the blind faith that what has worked for the last few decades will function forever. History cynically proves that this belief reaches its peak exactly moments before tectonic shifts occur. You mistake temporary stability for the absence of risk, but real risk is not the short-term movement of charts, but the permanent loss of your purchasing power. In a world where currencies are methodically devalued, inaction is not a neutral position. It is a conscious decision to accept one's bankruptcy. Your expectation of clarity is a trap for the weak. You want to get confirmation before you start acting. You're waiting for silver prices to already fly into the stratosphere, for media narratives to become unanimous. And experts in expensive suits will start nodding in agreement. But when the consensus is formed, the opportunity is already dead. Markets do not move when everyone is comfortable. They explode when the perception of reality changes suddenly and mercilessly. Those who protected their capital in advance were always subjected to ridicule and criticism for excessive pessimism, while those who waited for normalization remained with dust in their hands when the old normality crumbled to dust. By the time the risk becomes obvious to every layman, all paths to salvation are already blocked, and prices are adapted to the new cruel reality. Many ignore silver due to its negligible market size compared to the oceans of global finance. You assume that small size means insignificance, but in reality, this is precisely what makes it a weapon of mass destruction. The silver market does not need trillions of dollars to start moving. Even a modest redistribution of capital is capable of causing a domino effect. When institutional players or large private investors decide they need protection instead of performance, silver is revalued at the speed of a bullet. This is the mathematics of scarcity. When a finite resource meets sudden and massive demand, the price ceases to be linear. Possessing silver is not a bet against the future, and not an attempt to predict the apocalypse. It is an acknowledgement of uncertainty and intellectual preparation for it. True diversification is not owning a dozen different paper assets that depend on the same system. It is owning something that behaves differently in moments of systemic stress. Silver has repeatedly proven that it shows the best results precisely when trust in abstractions collapses. This is not a question of fear. It is a question of pure logic. Your mistake lies in thinking that you have time. You believe you will manage to react when the situation becomes critical. But historical transitions do not give distinct signals. They simply accelerate. What looked controlled during one year becomes catastrophic in the next. Silver begins its movement long before comfort returns to the system. In an era of great changes, resilience is more important than forecast accuracy. History is always favorable to those who understand the nature of cycles and act before circumstances put a knife to their throat. Survival is not an accident, but the result of conscious positioning in a world where reality, ultimately, always takes precedence over hallucination.